People sometimes ask me what I'd do differently if I were starting my investing career today instead of 70 some years ago. They want to know if the principles have changed, if technology has changed everything, if the opportunities are different now than they were then. And my answer surprises them, because what I do today isn't that different from what I did back then, at least in the fundamentals. But the execution would look quite different because the tools available now are so much better. If I were 25 years old in 2026, just starting to invest with maybe a few $1,000s to my name, here's exactly what I'd do. First, I'd recognize that I have an enormous advantage that I didn't have when I actually started, and that's access to low-cost index funds. When I began investing, if you wanted to own a diversified portfolio, you had to buy individual stocks one at a time. That required research, transaction costs, and enough capital to actually achieve diversification. Today, for the price of a single share, you can own pieces of 500 or more companies through an index fund. That's revolutionary, and most people don't appreciate how much of an advantage that is. So if I were starting in 2026, probably 80 to 90% of my money would go into a simple S&P 500 index fund or a total stock market index fund. I'd pick one from Vanguard, Fidelity, or Schwab with an expense ratio below 0.1%. That would be my core holding, my foundation. I'd set up automatic monthly investments, probably starting with whatever I could afford, even if it was just $100 a month, and I'd let it run. This isn't the exciting answer people want to hear. They want me to tell them about some sophisticated strategy or some secret to finding undervalued companies. But the truth is, for someone starting with limited capital and limited experience, you can't beat a low-cost index fund. You're getting instant diversification, minimal fees, and the returns of American business overall. Over time, that's going to beat most alternatives. Now, would I put everything in index funds? Probably not. I'd probably keep 10 to 20% to invest in individual stocks, but only after I'd built up some knowledge and only with money I could afford to lose. And I'd be very selective. I wouldn't try to own 30 or 40 stocks. I'd focus on maybe 5 to 10 companies that I understood well, that had strong competitive positions, that were run by people I trusted, and that were trading at reasonable prices. But here's the key. I'd only do this after I'd spent serious time learning to analyze businesses. I'd read annual reports. I'd study financial statements. I'd try to understand what creates durable competitive advantages. I'd look for companies with pricing power, high returns on capital, strong balance sheets, and management teams that allocate capital well. And I'd be patient. I wouldn't buy something just to put money to work. I'd wait for opportunities where the price was attractive relative to the value. This kind of analysis takes time to learn, and most people either don't want to do it or don't have the temperament for it. That's fine. That's why the index fund is the right answer for most people. But if you're genuinely interested in analyzing businesses, if you find it intellectually engaging, then setting aside a small portion of your portfolio for individual stocks makes sense. Just don't bet the farm on it. Let me talk about what I wouldn't do, because that's equally important. I wouldn't try to trade in and out of positions trying to time the market. I wouldn't chase hot stocks or whatever investment fad is popular at the moment. I wouldn't put money into things I don't understand just because everyone else is doing it. I wouldn't pay high fees to active fund managers who probably won't beat the index anyway. And I wouldn't panic and sell during downturns. These are the mistakes that destroy wealth. Not picking the wrong stocks, but making behavioral errors, trading too much, chasing performance, panicking during volatility, paying excessive fees. If you can avoid these mistakes and just consistently invest in low-cost index funds over decades, you'll probably end up wealthier than 90% of people who try to be clever. Now, let's talk about how much to invest. If I were starting today, I'd aim to save and invest at least 15 to 20% of my gross income, more if possible. This requires living below your means, which most people aren't willing to do. They see their income as something to spend up to. But if you can keep your lifestyle costs low, especially early in your career when your income is lower anyway, you can save a substantial percentage. Let's say I'm making $50,000 a year starting out. If I can live on $40,000 and invest $10,000, That's 20%. That's $200,000 over 20 years. If I never get a raise and earn nothing on it, which obviously isn't realistic, with raises and investment returns, it's significantly more. But the point is, the savings rate matters as much or more than the investment returns. I see young people making good money, 70 or 80,000 right out of college, and they spend all of it. They upgrade their apartment, they buy a new car, they eat out constantly, they take expensive trips, and then they wonder why they're not building wealth. You can't build wealth if you spend everything you make. It's mathematically impossible. If I were starting today, I'd keep my fixed costs as low as possible. I'd drive a used car. I'd live with roommates or in a modest apartment. I'd cook most of my meals. I'd be ruthless about cutting unnecessary expenses, not because I'm cheap, but because every dollar I don't spend is a dollar I can invest. And every dollar I invest in my 20s is worth several dollars in my 60s due to compound growth. People underestimate how much early money matters. $1,000 invested at age 25, growing at 8%, is worth about $21,000 at age 65. That same 1,000 invested at age 45 is only worth about $4,600. The 25-year-old's 1,000 is worth 4.5 times as much. That's the power of starting early. And that's why I'd prioritize investing over spending in my 20s and 30s. Let me talk about retirement accounts, because this would be a big part of my strategy. If I had access to a 401k with an employer match, I'd contribute at least enough to get the full match. That's free money, an immediate return of 50 or 100% depending on the match. There's no investment that beats that. Then I'd max out a Roth IRA every year. As of now, that's $7,000 a year if you're under 50. I do this even before contributing more to the 401k beyond the match. The Roth IRA is the best retirement account from a tax perspective because the money grows tax-free and comes out tax-free in retirement. You pay taxes on it now when you're young and your income is probably lower, and then you never pay taxes on it again. After maxing the Roth IRA, I'd go back and contribute more to the 401k if I could afford it. The limit is around $23,000 per year, which is hard to hit early in your career. But I'd work toward it, and I'd keep everything invested in low-cost index funds within those accounts. Now, what about asset allocation? If I were in my 20s, I'd be 90% stocks, 10% bonds. Some people say 100% stocks at that age. And I wouldn't argue strongly against it. You have decades until retirement. You can afford volatility. You need growth. But having a small bond allocation means you have something to rebalance from if stocks drop sharply. You can sell bonds and buy stocks when they're cheap. As I got older, I'd gradually shift to a more conservative allocation, maybe 80-20 in my 30s, 70-30 in my 40s, 60-40 in my 50s. By the time I was approaching retirement, I'd probably be 50-50 or 40-60 stocks to bonds. The exact numbers aren't as important as the principle, which is that you reduce stock exposure as you get closer to needing the money. Let me address something that would be a temptation if I were starting today, and that's cryptocurrency and other speculative assets. There would be enormous social pressure to put money into these things because everyone around me would be doing it and some people would be making a lot of money, at least on paper. I'd resist this completely. I wouldn't put $1 into assets I don't understand and that don't produce cash flow. Stocks represent ownership in businesses that make products and services, serve customers, generate profits. Over time, those profits drive returns. Cryptocurrency doesn't produce anything. It's purely speculative, dependent on someone else being willing to pay more than you did. That's not investing. That's gambling. I know some people have made money on cryptocurrency. Some people also win at casinos. But I'm not interested in gambling with my financial future. I'd stick to businesses. I understand assets that generate cash flow, investments with a rational basis for expecting returns. Everything else is speculation. And speculation is a good way to lose money. There's also the question of individual stock picking outside of index funds. If I were doing this, I'd focus on certain types of businesses. I'd look for companies with strong brands that have pricing power, companies that don't need a lot of capital to grow, companies that generate high returns on invested capital, companies in industries. I understand. I'd avoid businesses that are capital intensive, that have low margins, that face intense competition, that are dependent on commodities. I'd avoid companies with complex financial structures or management teams with questionable incentive structures. And I'd only buy when the price was reasonable relative to the business value. But again, this would only be a small portion of my portfolio, and only after I'd spent years learning to analyze businesses properly. For most of my investing life, the bulk of my money would be in index funds, because that's where the best risk-adjusted returns are for most people. Let me talk about education, because if I were starting today, I'd spend significant time learning about investing in business. I'd read annual reports of companies I was interested in. I'd read books about investing, about business strategy, about behavioral psychology and how it affects financial decisions. I'd study the history of markets, of manias and crashes, of what works and what doesn't over long periods. This education wouldn't cost much. Most of it is available for free or cheap. Annual reports are free on company websites. Books from the library cost nothing. You can learn an enormous amount without spending money on courses or seminars or newsletters. The information is out there if you're willing to put in the time. But I'd be selective about what I learned from. I'd focus on primary sources, on actual data and evidence, on people who have track records of success over decades. I'd ignore most financial media, which is mostly noise designed to generate clicks and views rather than help people make good decisions. I'd ignore people selling get-rich-quick schemes or claiming to have secret systems for beating the market. I'd stick to the basics, the principles that have worked for 100 years and will probably work for the next 100. Now, what about real estate? If I were starting today, would I invest in rental properties or house flipping or any of that? Probably not, at least not early on. Real estate can be a good investment, but it requires significant capital. It's not liquid. It comes with the responsibilities and risks that stocks don't have. As a young person just starting out, I'd keep things simple and focus on building liquid wealth through stocks and bonds. Later, maybe in my 40s or 50s, once I had significant assets built up, I might consider real estate as a way to diversify, but I wouldn't make it my primary focus. The returns from real estate, after accounting for all the costs and time involved, often aren't better than stocks, and stocks are much easier to manage. Let me talk about one more thing, and that's the importance of staying invested through difficult periods. If I started investing in 2026, I would almost certainly experience at least one major downturn in the first 10 years, maybe multiple downturns. The market would drop 20 or 30 or 40%. My account balance would fall significantly, and that would be the moment of truth. Most people panic during these periods and sell, locking in their losses. They wait until things feel safe again, which usually means after the market has already recovered, and then they buy back in at higher prices. They've turned a temporary decline into a permanent loss through their own actions. If I were starting today, I'd prepare myself mentally for this in advance. I'd expect downturns. I'd understand they're a normal part of investing, and I'd commit to not selling during them. In fact, I'd commit to keeping my automatic investments going during downturns, buying more shares at lower prices. This is hard psychologically. When everyone around you is panicking, when the news is dire, when it feels like things will never recover, keeping your cool and staying invested requires discipline. But it's essential. The people who build wealth through stock investing are the ones who don't panic during bad times. I'd also limit how often I check my account balance. Maybe once a quarter, maybe once a year. The less I looked at it, the less I'd be tempted to make emotional decisions based on short-term movements. The volatility is much easier to tolerate if you're not watching it constantly. Let me give you a concrete example of what this would look like over a decade. Say I started age 25 in 2026 with $5,000. I invested in an S&P 500 index fund. I also set up automatic investments of $500 per month. In the first few years, everything goes fine. My account grows steadily. By year 3, I have maybe 25,000. Then year 4, there's a crash. The market drops 35%. My account goes from 25,000 to about 17,000. That's an $8,000 loss. It feels terrible. But I don't sell. I keep my $500 monthly investment going. I'm buying shares at much lower prices than before. Over the next 2 years, the market recovers. By year 6, I'm back to 25,000, and then I blow past it. By year 8, I have 50,000. By year 10, I have about 80,000. Compare that to if I panicked in year 4 and sold at 17,000, I'd have 17,000 in cash, earning almost nothing. Even if I got back in eventually, say in year 6 at 25,000, I'd only have about 60,000 by year 10. I'd be 20,000 behind where I would have been if I just stayed invested. That's the cost of panic. That's why temperament matters more than intelligence in investing. The smartest person in the world who panics and sells at the wrong time will do worse than someone of average intelligence who stays disciplined. If I were starting in 2026, I'd also be very mindful of fees. I'd use index funds with expense ratios below 0.1%. I'd avoid funds charging 1% or more. I'd avoid financial advisors who take 1% of assets annually. Over a 40-year investing career, the difference between paying 0.05% and 1% in annual fees is hundreds of thousands of dollars. On $100,000, 0.05% is $50 per year. 1% is $1,000 per year. That doesn't sound like much, but compounded over decades, it's enormous. You're giving away a huge portion of your returns for services that probably don't add value. Most active managers don't beat index funds over long periods. Why pay them to underperform? I'd also be careful about taxes and taxable accounts. I'd hold index funds for more than a year to qualify for long-term capital gains rates. I'd avoid funds that generate a lot of taxable distributions. I'd use tax loss harvesting if I had losses to offset gains. These small tax optimizations add up over time. But I wouldn't let tax considerations override basic investment decisions. Sometimes people hold on to losing investments because they don't want to realize the loss for tax purposes. That's backward thinking. If an investment is bad, sell it and move on. Take the tax loss if there is one, but don't keep money in bad investments for tax reasons. Let me talk about one final thing, and that's the importance of continuing to invest even after you've accumulated some wealth. I'd set a target, maybe $1 million or whatever number represents financial independence for me, but I wouldn't stop once I hit that number. I'd keep investing, keep building, because you don't know how long you'll live, what unexpected expenses will arise, what opportunities might come up. The people who build real security are the ones who never stop. They keep living below their means, keep investing the difference, keep letting compound growth work. They don't plateau at some number and then start spending everything they make. They maintain the discipline that got them there in the first place. If I were starting today, that's the mindset I'd have. Not that I'm trying to get to some number and then I'm done, but that I'm building a lifelong habit of saving and investing, of living below my means, of letting money work for me rather than always trading my time for money. So to summarize, what I'd do if I were starting to invest in 2026, I'd invest primarily in low-cost index funds, probably 80 to 90%. I'd save 15 to 20% of my income or more. I'd max out retirement accounts, especially the Roth IRA. I'd start with a very aggressive allocation given my age, maybe 90-10 stocks to bonds. I'd avoid speculation in things I don't understand. I'd keep expenses low and fees low. I'd stay invested through downturns. I'd educate myself continuously about investing in business, and I'd maintain this discipline for decades, letting compound growth do the heavy lifting. This isn't a sexy strategy. It won't make me rich overnight. It won't give me great stories to tell at parties, but it will work. Over 30 or 40 years, this approach will build substantial wealth for anyone with the discipline to stick with it. And that's what matters. Not excitement, not complexity, not beating the market by a few percentage points, just consistent, disciplined, low-cost investing over long periods. That's what I'd do if I were starting today. It's not that different from what I've been saying for decades, because the principles don't change. What's changed is that it's easier now than ever to execute this strategy well, thanks to low-cost index funds and online platforms that make investing accessible to everyone. If you're young and just starting out, you have an enormous advantage. The question is whether you'll use it.